But first, joining me right now is Labenthal Global Advisors President Dominick Tavella. Dominick, good to see you. What's happening this morning on this final trading day of the third quarter? We've got a bounce, but we know what the trend has been. Investors are nervous over higher interest rates and a slowing economy. Is today's move sustainable?
No, we've had a brutal month. We have the S&P for the month down about 8%, the NASDAQ 9%. We might get a little bit of a bounce today, or maybe a little bit of a relief bounce today. But I think you were spot on, Marie, in saying it's a global slowdown, economic slowdown. We're all seeing it. It's obvious. And now we're looking at earnings going into for the third quarter, and the expectations are that we're finally going to start to see earnings really come down a little bit here, and then we're going to reprice the S&P based on a reasonable multiple. So we might get a little bit of a relief bounce today. The inflation data might be a little bit better today, but I think short term, the next month or so, probably lower before we go higher.
Well, look, Larry Summers has been critical of the economic policy for a while now, and we've got more comments this morning from the former Treasury Secretary. Larry Summers warning that global economic risk right now is approaching the pre-Great Depression Great Recession levels, rather, comparing people's anxiety to what happened in 2007. Dominick, here's his quote: "We're living through a period of elevated risk," Summers said, and in the same way that people became anxious in August of 2007, I think this is a moment when there should be increased anxiety. Your thoughts on Larry Summers' comments?
I hadn't heard it before just now, Maria, but I couldn't agree more. Look, we know the consumer is 70% of the economy. So if the consumer is feeling good, feeling happy, they go out there and spend. Economic activity increases, and it overall benefits everybody, right? But if people start feeling stressed, and my clients are just normal, so they're right there, Maria. You're feeling stressed about what's going on with the markets. You feel stressed about what's going on in the real estate market. The political situation in Washington is just absolutely a disaster in their eyes, and they stop spending, Maria, and that means economic activity stops, and we go into a recession.
Yeah, Dagan, we are about to begin the fourth quarter, and that is where so many people are saying this ugliness may very well start and head into 2023. I'm talking about a long and deep recession. Jump in here, Dagan.
Right. What the Federal Reserve is doing to try and tame the inflation that it and other central banks created, along with reckless fiscal policy coming out of free spending Democrats, is the end of a multi-decade era, Dominick. Do you agree with that for years and years, investors got really easy returns in stocks and real estate because you had negative real interest rates, and that is changing. We've had 40-some-odd years of falling interest rates, and now we've had a reversal of that. And what the Federal Reserve is doing right now, we will not, as an economy, feel it for at least another year and a half. So we're not talking 2023. We're talking deep recession into 2024.
So I agree with both parts of that, Dagan. And we focus on the Fed and their really easy interest rate policy, and it clearly created bubbles in the real estate market. We had 20 people online overbidding for real estate. It happened in the SPAC market. It happened in the cryptocurrencies. But what we don't talk enough about is the fuel to that fire, which was just reckless spending by Congress, just billions and billions and trillions of dollars being stuffed into the economy, giving people the liquidity to go out there and spend and speculate. So clearly all that hopefully is going to come to an end. Higher interest rate environment is going to make people think twice about whether they're buying a stock or they're buying a piece of real estate, whether it's actually a good investment. And in the long run, this will be healthy for the economy, but we have to go through this pain. And I don't know how long it's going to last. I'm hoping by the end of this year, maybe there's a political situation change in November. Things start to change a little bit, and we can look forward to next year, maybe the end of next year, things being a bit better.
Well, the midterms could be a catalyst, you're right. But, Dominick, in the middle of this pain, how do you stay safe? How are you allocating capital right now? Are there areas to hide in the middle of this repricing that we're witnessing?
So historically, yeah, September, October is a really bad period. So we actually increased our cash from the last time we spoke, Maria. We're sitting with about 30% cash. But if I look at the environment out there, healthcare is a terrific place to be. It's usually pretty good in a recessionary environment. Energy, as much as it's up year to date, it's actually down over the last 3 to 6 months. I think as we go into the end of this year and into next year, we can see higher energy prices. And the really hated financials, the XLF is the ETF in the financial sector. Everybody seems to hate the big banks, but they will print money in this environment as long as we don't go into a deep recession. And I don't believe we will. So I think the XLF financial is a terrific place to, but you have to nibble, Maria. You can't go in the short end of the pool here head first. You put 2.5% of your cash in at a time, different sectors, very methodically, and you have to be patient. You really have to be patient here.
Well, if you look at the biggest weak spot for September in the equities market, it's FedEx, down almost 30%. That is indicative of the economic slowdown right there. So you want to really look at what's happening. You could see that play out in the stocks that have moved accordingly in the month of September as we close out this month. Dominick, it's good to see you this morning. Thanks very much.
Thank you, Maria.